Do you want to know how to buy unlimited rental properties without having to go through traditional banks? If you're an active real estate investor, you're probably aware that going through a bank is challenging, especially after you buy multiple rental properties. You want to buy your first one and go through a bank and go through all the red tape, no problem. But after you buy multiple, it gets very complex to continue to go through a bank. Your debt to income ratio ends up being too high. They have Fannie Mae loan limits. Um, the analyzing of your tax returns just gets too complex. An institutional backed lender that offers a DSCR product, a debt service coverage product, is really the way to go if you're an active real estate investor. Hi, my name is Jason Dale, and if you don't know me, I own a company called Hard Money Bankers. We've done over 4,000 private loans to real estate investors all over the place, and I want to help you today by learning how DSCR loans work and the qualifications. And I think you'll be surprised. It's a lot easier than you think to get a debt service coverage loan on your rental property. And terms are pretty good as well. So it's a really, really good product that's been around for about 10 years. And it's a very good, needed product for real estate investors that are buying rental properties. So, let's talk about a little bit how they work. So the way that they're underwritten is through a model called DSCR, debt service coverage. And what ends up happening is, think about it like this. If you own a rental property and your principal, interest, taxes, insurance, and your homeowners association fee, if it has a homeowner association, is $1,000 a month, and you're getting $1,000 a month in income, right? So let's say you get $1,000 a month in income, your expenses are $1,000 a month, you'd have a calculation of 1, right? So forget your personal income and how much you can qualify for. If the property itself is spitting off $1,000 a month in income and your expenses are for principal, interest, taxes, insurance, homeowners association is $1,000 a month. In essence, you're breaking even, but the property is self-sufficient. You don't have to put any money in every month. It covers itself. That's called a calculation of a 1. Now, that's obviously not all that ideal. The purpose of buying rental real estate is for it to cash flow for you, but that's kind of where it is. And on the other side of that, a very, very good calculation would be 1.5. So for every $1,000 in expenses you have, you're bringing in $1,500 a month in rent. So you have $500 of positive cash flow. So typically the requirements are, and this is similar to a bank, but probably more lenient. Usually a lot of these DSCR lenders can do it at like a 620, 640 minimum credit score. Ideally for the best terms, 680, 700, 720, stuff like that. And usually about a 20% down payment. Now, when I'm recording this video, this is kind of what the terms are as of now, but it may change no matter when you're watching this. So, interest rates are like in the 7s, give or take, which is maybe even as high as 8, but like in the 7s, which is similar to what a bank is anyways. In general, DSCR lenders are slightly more expensive than banks, but they just have so much more flexibility. And they also can do longer term. The majority of their terms are 30-year loans. So you're doing a 30-year loan locked in, and what your income, your debt service coverage ratio is. And hopefully over time, your expenses stay similar, maybe go up a little bit, but also you can raise rents. So let's go through a real case study, of a deal. And this deal is local in our market in the state of Maryland where we are. But let's just say an investor buys a property. It's a 3-bedroom house for $210,000. They pay $210,000 for it. They put down 20%, which is $42,000. And then they borrow $168,000. The property rents for $2,400 a month. All right, I'm going to give you some of the numbers, and I'll show you how it breaks down. The taxes are $3,500 a year. Insurance is $1,200 a year. And their total monthly principal, interest, taxes, insurance, and association dues come to $1,850 a month between all of it. That's their expense. So keep in mind, they're getting $2,400 a month in rent. So their DSCR coverage is 1.3. You take $2,400 in rent divided by $1,850 in expenses, you have a 1.3. That's a pretty strong ratio. And also, with that ratio, it qualified them for 20% down, whatever the current competitive rates were. in the sevens. So that's a pretty good kind of benchmark of what to look for. In general, when you're looking at DSCR stuff, 1.5 is superb. If you can get something around 1.5, like that's great. 1.25 ish, 1.3 is ideal, and 1 probably not recommended. You might be able to get a lender to fund it, but it's not all that recommended to do that. This product again is great because you can do a 30-year fixed. Now with these DSCR types of loans, with the 30-year fixed product, they do have prepayment penalties. It's typically like a waterfall, like a 5, 4, 3, 2, 1. So if you pay it off in year 1, it's a 5% prepay. Year 2, 4%. Year 3, 3%. And then after 5 years, there's usually no prepay. So that's a benefit of dealing with going over a conventional loan, and then or like a bank loan. The only benefits the banks really have is that the capital's slightly cheaper, slightly cheaper. But it's a hassle. A lot of times they won't get approved, and most of them aren't going to do 30-year fixes on some of this. So there's a lot of good with this DSCR product. And then if you compare that to like a hard money loan, most hard money lenders, that they're looking for more shorter term. They're not looking to deploy their capital for 30 years. Now, one of the things that we do regularly is we work with a lot of rental real estate owners. They come to us, they're purchasing a property that needs some work or there's no tenant in there. We'll give them short-term bridge capital. In essence, they're bridging the gap between the purchase and then the refinance and the DSCR product. So we'll give them capital up front to purchase the property, renovate the property, get it stabilized, put a tenant in there, and then they'll refinance our short-term hard money loan into a long-term DSCR loan where they can keep out for 30 years. So all in all, it's a great product. If you're not familiar with it, definitely check it out. You can go to hardmoneybankers.com to learn more about what we do at Hard Money Bankers. But if you're an active real estate investor and you're doing deals, especially for rental properties, like you need this product. You can't be contingent on a bank, or you can't be contingent on using your own cash. And most hard money lenders or private lenders, they're not looking to keep their cash out or deploy money for long periods of time. So, and listen, the reason they put some of these DSCR requirements in place is they want to make sure it's a good investment, obviously for them as the lender, but also for yourself. If you're doing a deal and you're not cash flowing on it every month, how long are you going to keep that? You're going to have to come out of pocket every month. So these qualifications are based on the debt service and can manage the debt service, not on your personal W-2 or your personal income, which makes this nice. And banks would, want to make sure that you can cover it. The property suffices. So if you found this interesting, feel free to comment below this video. If you have any questions, feel free to comment below this video. Happy to answer them. Again, Jason, Hard Money Bankers.